All right, good afternoon, everyone, and welcome to Network 2020's discussion about the future of the US dollar. We have two highly accomplished guests today, and I'm very eager to get to the conversation. But first, I'll just start with a few words about Network 2020. We are a New York City-based nonprofit that brings nuanced and incisive conversations about global affairs to rising and established leaders both virtually as well as in person in New York. So I encourage everyone to follow us on LinkedIn, Facebook, Twitter, Instagram, subscribe to our YouTube channel, or our Global Insights podcast to access our library of on-the-record discussions. So with that, it is a great pleasure to introduce our two guests today. First, I'm very pleased to welcome Dr. Ottaviano Canuto. Dr. Canuto is a former vice president and former executive director. He was former executive director at both the World Bank and the International Monetary Fund. He was also Brazil's former deputy minister for international affairs, among other accomplishments. And I'm also pleased to welcome Dr. Jeffrey Frankel. He is professor of capital formation and growth at Harvard and a research associate at the National Bureau of Economic Research. And he served at the U.S. Council of Economic Advisors multiple times. So we're very lucky to have both of them with us today for a conversation that I must say is a little bit outside of my lane, and I'm having to go back a decade and a half plus to my macroeconomics classes in grad school. So please bear with me. Dr. Frankel, I'd love to just start with you for a little bit to talk a little bit of overview and scene setting. So could you please just explain to us what are some of the historical factors that really made the dollar the world's reserve currency?
So let me first define reserve currency as a currency in which central banks of other countries want to hold their reserves. It used to be pound sterling back on the gold standard and up until World War I. The British pound was by far the leading international currency, and the dollar wasn't in the listings. Then sometime in the 30s or 40s, the dollar passed, and it's partly because Britain became a big net debtor and suffered inflation in World War I, during World War I. And the US dollar satisfies the criteria for an international currency. It's a big part, the currency of a big country with a lot of trade. Its value is pretty stable. The value of the dollar is pretty stable. If you want central banks to hold their reserves in your currency, you'd be better offer them a reliable rate of return. And one problem in recent years is exploitation, overuse of what's called exorbitant privilege. The exorbitant privilege is the right to print your currency and have other people hold it, and they have to give you goods or services or hard assets in exchange. You can abuse that by running big budget deficits and printing a lot of money and causing inflation or depreciation. That used to be what people were worried about. But more recently, they've worried about abuse of exorbitant privilege in the form of excessive use of sanctions. Should I show the graph now of the shares so you can see what? So figure one, please. So you can see the dollar is still by far number one share of foreign exchange reserves held by central banks. But if we look at the down arrow, yeah, it's been declining in share ever since the turn of the century, and it's been declining at a faster rate. That says since 2025. It's supposed to be since 2015. The second red arrow, 2015, decline accelerated. You might think that people were shifting into euros, which is the number two reserve currency, but that has not been the case, as the yellow line shows. You might think they've been switching into Chinese yuan, but neither China nor Europe has adequately deep, liquid, open capital markets, which is another requirement for having your currency used as a leading international reserve currency. So they're still lagging pretty far behind. Instead, some central banks are shifting into smaller currencies that you wouldn't think would be on the list: Australian dollar, New Zealand dollar, Korean won, Danish kroner, Swedish kroner, and gold. Let's go to the next slide. and the arrows. You can see that the share of dollars in reserve holdings has diminished, particularly since 2015. And it's not that the share of euros has risen. The rest have risen a bit, but it's especially gold that's risen. Now, some of that increased demand for gold is taken the form of an increase in the price of gold, but it still stands that investors, central banks are shifting their portfolios into a higher share in gold. And so the big question is, will this trend continue? Will the dollar lose its status as number one international reserve currency?
Okay, thank you. And then you've maybe started to allude to this, but what are some of the benefits and burdens that being the reserve currency has conferred on the US, particularly in these last 50 years?
Okay, benefits for the whole world. It's useful to have a single reserve, leading international reserve currency, and other international uses of currency like denominating trade and invoicing and so on. The advantages to the US are number one, just the obvious one, is it makes things more convenient for travelers and importers and exporters and all that, just to be able to do business in their own currency. Number two, it means more business for US banks and the other financial institutions. But number three, the one that's really most important is seigniorage, which means the ability to print the money and spend it. And that shows up as being able to borrow at a lower interest rate than other countries. U.S. Treasury bill interest rate has been very low for a long time, in part because the dollar and the Treasury bill is the preferred liquid reserve market for everybody. Also, there are an advantage is geopolitical power, the ability to more likely enforce sanctions. Disadvantages, there are disadvantages. It's not all just advantages. And it's interesting that when the yen and the mark seemed to be rising as international currencies, the Japanese yen and the German Deutschmark, the business sectors didn't want it. They were opposed to increased international reserve currency use. And the reason is that they feared that upward pressure on the value of the currency and more variable pressure on the value of the currency would hurt their exports.
Okay.
On net, I think it's a beneficial thing, however.
All right. Thank you. Turning to you, Dr. Canuto, for the rest of the world, and I realize that that's a very large swath to cover, but what has it meant to operate in an international system anchored on the US dollar? And then if I can append another question to that, we've heard a lot of talk recently among the BRICS countries about an alternative to the dollar, but this isn't the first time that we've heard such talk. Do you feel that this kind of talk is meaningfully different from the kind of post-1971 conversations, or do you kind of see a real medium-term momentum toward a BRICS currency or payment system?
Right. Well, it's a pleasure to be here, and particularly with such a company. See, any talk about a common currency of BRICS countries, it makes no sense. There is no basis for that, okay? Well, we should keep in sight what exactly is the BRICS, particularly the BRICS Plus. And I recommend reading a piece that I published this year together with Bruno Saraiva on exactly what are the BRICS. And by the way, for 2 years of my time as vice president of the World Bank, my boss, Bob Zalek, made me, and followed by his successor, made me a special advisor on BRICS countries at the World Bank. See, originally, the BRICS were simply, a grouping thought to boost the power, the voice of the constituent countries in during the redesign of the World Bank and IMF and so on. Later on, it became clear that there would be limits for their intent to raise their shares and so on. And they decided to create their own alternative institutions, more complementary. I have another piece on this showing how the BRICS Bank and the multilateral institutions are more complementary than substitute. Okay, now it has been, of course, the geopolitical uh, uh, rise of factors that led some of them to try to make it something broader than that. But it's simply an agglomeration of countries with no, let's say, some sort of unification that could lead to some sort of issuing a common currency. Having said that, okay, once we do not confound BRICS with or Russia, Iran, or even China because of the sanctions and those ideas of a Western versus non-Western world and so on. The fact of the matter is that they have, let's say, a common agenda that supposedly is beneficial for all of them. Okay. Although there is no common currency at stake, they can make advances on payment systems. Professor Frankel has rightly observed that you have international money both as a means of payment and as a reserve of value, right? And the two functions, of course, tend to reinforce themselves, but they do not exclude possible increase, for instance, in the role of payments. A short story on why we don't see any possibility of the Chinese renminbi rising to the stake of challenging the dollar and so on. In 2015 and 2016, I was one of the executive directors at the board of the IMF when uh, the inclusion of the renminbi into the basket of currencies that serve as the basis for the SDR uh, uh, was evaluated by the board, by the institution. It had been denied in 2010, but 2015 the signals coming from the West were much favorable, and there China came with the renminbi. Why I'm telling this? It's because China passed by two of the three criteria, the renminbi, share of trade finance, obviously, given the size acquired by the China's trade, it was easy to pass this criterion. The second criterion was to have public debt negotiated in at least two of the major capital markets of the world. China had in Hong Kong, China, and then it issued a bond in London, so that was fulfilled. But the third one, share of financial transactions, the renminbi would not, right? And among the preconditions established by the IMF was that China should smooth the linkage between the financial markets in Hong Kong, China, and continental China. And China did it, okay? But then, in a matter of a couple of months, $300 billion left China. In the words of my colleague from China at the board, he said it was Chinese money leaving Chinese hands and going to Chinese hands. It was the opportunity to diversify wealth by the Chinese and so on. But $300 billion in a short time was enough to make China retroactively stop so the point is that China has clearly, abdicated from becoming a source of reserve keeping, value keeping by the rest of the world, but which does not impede to try to push the renminbi whatever it can. And that's the case of payment systems. Because despite the fact that payments and reserve of value tend to reinforce each other, for instance, the more you have a trade in a currency, you must have precautionary reserves by central banks. There is a difference now, and this makes the current moment a little bit different from the previous ones mentioned by you and the times in which the magnificently Professor Frankel described the rise of the Deutschmark and the yen and so on. SDR has always been limited to being an accounting money by the IMF, but the euro fell short from as Professor Frankel highlighted quite well. It is not a fiscal union. It doesn't have the liquid assets, the volume of investment grade assets to offer as reserve of value and so on. But now, with respect to China and the BRICS and other countries, there is a difference. And let me highlight on this what is different now. First, building blocks already exist. If I may have my chart one. See, now there are different national rails, let's say. The SIPs from China, the UPI from India, the MIR by Russia, the PIX by Brazil. And there is also digital payments expertise. So the BRICS are not starting from zero in this payments platform. And indeed, the recent cooperative work has focused on interoperability and some cross-border prototype, often labeled BRICS Pay or BRICS Payment Platform. That makes a difference when it comes to payments, of course, relative to the past. And obviously, the sanctions and geopolitics accelerated the momentum. But the fact of the matter is that technology lowers some of the traditional frictions. Now you have messaging systems, tokenization, and cross-border application programming interface that make more technically feasible than in the 70s until the 90s. Okay, so the point is that in the short to medium term, one can expect some partial de-dollarization when it comes to payments, but not any sort of a wholesale dethroning of the dollar. We are watching more trade invoicing in local currencies, more regional payment rails, and partial diversification of reserves. This will lessen the dollar's share in some corridors and some sectors, and it will create pockets of alternative structure. But still, the key barriers to dethrone the dollar no, still remain there. That is to say, as Professor Frankel highlighted, the death and liquidity of the U.S. asset market with no alternative, legal and institutional trust, unless any drastic movements are made on the U.S. side, the openness of capital markets, and the simple network utility of having a single dominant unit of account. Okay, and of course, Madame Lagarde, the president of the European Central Bank, in a very good speech in Germany earlier this year, outlined an agenda very much compatible as well with Peter Draghi's report, outlining what would it take for the euro to become an alternative. But that's a long and hard way to cross in order to make it an alternative. So, in a nutshell, I foresee a huge development in expansion. Think of the trade, the bilateral trade. China has become the #1 destination of exports of most of South America, just to give an example, #1 client. And so that makes possible, if the country's pursue is not automatic, the use of local currencies that might boost the use of the renminbi as well as the local currencies. See, this has a history. Latin America had a program of bilateral use of bilateral currencies to minimize, to economize the need of precautionary reserves in dollars. But as the reserves of these countries grew, and there was a default by Venezuela anyway, it's being dismantled. But the point is that there is a scope to go in terms of payments that can be pursued by, and it is already rising.
Thank you. Why don't we jump off from there, back to you, Dr. Frankel, to pick up on some of what Dr. Canuto was saying about the hurdles. How are current U.S. policies, things like tariffs, sanctions, interest rate pressures, political noise around Fed independence, how are all of those policies and talk impacting some of the various roles that the dollar plays worldwide? Why don't we start with that?
So the factors you named there and some others are working to undermine the role of the dollar. The decline in the dollar is a long-term phenomenon, so it's not just what's been going on lately. But as I mentioned, the process has accelerated since 2015, which, among other things, is the year when the U.S. applied sanctions on Russia with the invasion of Ukraine. So, I mean, number one, huge budget deficits. We have budget deficits larger than ever, debt larger than ever, and the ratio of debt to GDP is just about larger than ever. The economist's definition of unsustainable debt is debt that's not just rising, but is rising faster than the size of the economy, faster than GDP. So the ratio of debt to GDP is rising. And the peak, as I was saying, it was 1945. It came down throughout the post-war period up until the 1980. And it's been going up since, with the exception of the late 90s. It came down again a bit. But more recently, it's been growing at an accelerated rate. And the gridlock in Washington, it's worse than gridlock, suggests that they're not going to come together anytime soon, the two parties, to solve the problem. So this is the graph I was asking for. Debt to GDP peaking in 1945, and we're now really at the same level again, or just about to reach the same level again, with no sign of diminution. That's one factor. Pressure on the Fed to print money, lower interest rates, and with the attendant likely increase in inflation is a second reason for declining use of the dollar, declining shares of central banks' holdings of dollars. Indiscriminate use of sanctions. I don't count the 2014 sanctions against Russia for invading Ukraine as excessive or irresponsible, but there's been others. Number four, just in general, the chaos in Washington, the unpredictability, the undermining of confidence in the word of the U.S. president, the crazy tariffs, which are bad economically, but they also violate international agreements blatantly. International agreements which we led the process of negotiating. Gratuitous ruptures with allies, quitting international institutions, undermining the independence of the Fed, and flirting with default. It's not just that the debt to GDP ratio is rising, it's that the White House isn't even paying lip service to the principle, it seems, currently. Trump has said he loves debt, that there's things you can do to renegotiate debt, which that means default. So you've never had a Treasury Secretary or a president before saying anything that could be interpreted by investors as maybe I shouldn't have confidence in the 100% safety of the U.S. But the current administration seems to be going out of its way to flirt with that. All these things undermine the position of the dollar.
Thank you. I just want to be cognizant of time because I want to be able to get to audience questions as well. And if you're listening and you have a question, question, please feel free to put it in the Q&A box. Dr. Canuto, I want to turn back to you. You covered some of what I wanted to talk about when it comes to China already, which I think is useful. What I'm curious to hear from you now is whether you think that there could ever be, because what I'm hearing is that there's almost, kind of maybe I don't want to say fragmentation because that seems like too strong a word, but just a slight recalibration in terms of, how transactions are being done and where reserves are being held. Is there a plausible tipping point at any point? Is there a time at which, things change to the point where all of a sudden, it accelerates? And what indicators would you be watching to know whether countries are gradually coordinating around an alternative currency, or that, the US dollar is, on an upward surge again?
Right. See, I don't see any abrupt wholesale tipping point knocking the dollar from of its the position. See, the more realistic near to medium term outcome, I would say, is a more multiplex system where the dollar stays central for global funding and safe asset needs, while several regional or functional currencies, the renminbi, the euro, eventually, any basket of platforms, they grow in transaction and corridor roles. And that has been the push, particularly made by think of what China has been doing is replacing in transactions and indeed building and expanding the payment rails and clearing. China has been promoting offshore renminbi liquidity and market centers, Singapore, London, Hong Kong, and so on. And it has encouraged the state actors to use the renminbi in trade and finance and so on, but not to the point of being able to substitute the dollar and establish another system around the reserve value function. But indeed, the figures point clearly the rise of payments done in renminbi. Now, having said that, the question is the extent to which these systems can coexist, right? And indeed, look, if I may take my fourth chart, the one that shows the the network of swap lines signed by the PBOC with particular countries. That's my chart for it. Anyway, I can go. See, one may think of the external financial defenses of countries as comprised by, on the one hand, of course, the country's own national reserves, and another one, which is the global safety net, which with the IMF at the center, providing global liquidity for all of the countries, using the SDR to swap currencies and so on. But there is an intermediate layer that has been tentatively developed that appears, particularly in moments of crisis, which are the bilateral swap lines between central banks, as the US did, as the Fed did during the pandemic, and before that, as the euro at a certain moment also developed. And China has moved in that direction. And signing bilateral swap lines with individual countries. And by the way, 2 years ago, before President Milei took over, that was the swap line between the Central Bank of Argentina and the PBOC that allowed Argentina to avoid the default to the IMF, right? It's quite important because the tentative response by Scott Bessent more recently it's implicitly a way to show that also the Fed, the United States can perform that role. But my point here is that, and by the way, of course, given the inferiority of the renminbi as a means to intervene in markets, these bilateral swap lines between the PBOC and countries have not been used more frequently. But having said that, they are there. This is a way by which we're going to see in that intermediate layer of reserve, that is, say, the one provided by central banks, something like this. And also, of course, one should differentiate this from the idea of trading in local currencies. The only advantage of trading in local currencies is economizing on the need to have precautionary reserves in dollars in order to intervene in the markets. But also there are costs. I explain. Brazil has had a trend of exhibiting a payment surplus with China. When one takes into account, adds the trade, the primary, the trade surpluses that Brazil has with China on goods, and also the FDI, the investments of China in Brazil. So that means that using local currency between Brazil and China, that means ultimately that Brazil would accumulate reserves, the central bank, in Chinese currency instead of dollars. And obviously, the functionality of reserves in renminbi vis-a-vis the dollar in terms of power of intervention is quite lower. So it is not without cost. But nonetheless, Brazil, you might ask me how effective has been this agreement of China and Brazil in using local currencies. A treaty, a pact was signed in 2023. There is no enough visibility, transparency about how effective it has been. And informal, there's no bulletin, there is no, not much disclosure in that regard. But the news that go through the analysts, the observers, is that 40% of the operations between Brazil and China have been done using local currency, not value necessarily. I'm talking about number of transactions, okay? And since in the case of Brazil, there is no mandatory, let's say, exchange, the exporters try to obtain their revenues preferably in dollars, not in renminbi. But there has been, particularly in the case of politically motivated transactions, some pressure from China for Brazil to issue trade invoices in renminbi. I read about a big cellulose export from Brazil that has been nominated in renminbi. So my point, just to complete and go to the question, is that we are likely to watch this multiplexity, okay? Because any sort of tipping point would first need some alternative, deep, open, trusted, safe asset, as well as market liquidity and hedging in alternative source, and which is not, let's say, foreseeable in the immediate future. But I would, since you asked me, if I am someone watching this, I would look at the reserve allocations. I would look at the share in global payments, comparing SWIFT with SIPs and so on. Yeah. I would look at the openness and depth of sovereign bond markets and liquidity of repo and derivatives markets. I would look at the foreign exchange market turnover. I would look, of course, on the evolution of the legal, regulatory, and convertibility systems, and so on. But I don't, in a nutshell, I guess the most likely scenario is watching a transaction growth without reserve
Mhm.
shifts.
Okay.
Okay. But with the three happening, in simultaneously in co-living.
Yeah. So it sounds like we could adapt to this multiplex world and just keep an eye on things for a bit. I want to pick up on that thread about trust before I go to the Q&A. And turning back to you, Dr. Frankel, what do you think a coherent U.S. strategy to preserve confidence in the dollar might look like? And I'm just kind of jumping off of this Gideon Rachman wrote recently in the Financial Times about the Trump doctrine, and that's basically don't trust America. And so, what can the U.S. do to really preserve confidence in the dollar?
Financial Times saying "Don't trust America" is explicit slogan from America, or it's just reading between the lines?
I think it's just Gideon Rachman's idea of the Trump doctrine.
Yeah. Well, trust is important if you want investors around the world to hold your debt, your bonds. It's important if you want to maintain this number one role as an international currency. And we're losing trust. We had tremendous amount of trust after World War II and accumulated uh, by virtue of, in essence, really leading the world during this period, which is, let's not forget, the last 75 years have been unprecedented in human history so far as we know for peace and prosperity. And a lot of that is due to the international institutions like the IMF and World Bank and the GATT and the WTO and so on, the UN, I guess. Um, and we're throwing away U.S. leadership. We're violating. So you asked the question the other way. What could we do to restore, to protect the use of the dollar? I mentioned putting the budget deficit on a stable path for a sustainable path for the long term, emphasizing the independence of the Fed and not pressuring them to lower interest rates, abiding by law, both domestic law and international agreements, like the rules governing international trade, and just not talking loosely about the default as a possibility,
Yes.
not talking about the capital controls or the danger that it might be a serious strategy for the U.S. to force international holders of treasury bills to convert them into something else, which should essentially be default. Let's see. Well, just the other ways in which we've got chaos currently, bringing back some stability and some rationality to the way we run the government.
Yeah. May I add, Courtney, something to the great response by Professor Frankel? Say, of concern, this clear option by Mr. Trump's government toward unilateral or bilateral transactions rather than reinforcing the multilateral structure. As I tried to convey in one of my answers, uh, more than ever, we need more lending space by the IMF. The existing space, despite the issuance of SDRs, is really limited. And in that regard, the lower preference by the current government with respect to multilaterals, and that includes raising the capital of the World Bank and so on. On the contrary, there was even the threat of leaving the World Bank. So it doesn't bode well in that regard. Whereas the attitudes or examples like the movement made by Scott Bessent toward Argentina is illustrative of this bilateral. And Professor Franco remarked it quite well, the looming threat coming from the fiscal side, and also on the threats to curb the autonomy of the central bank, of the Federal Reserve Bank, right? Uh, we didn't have the time to discuss here. Fortunately, the idea of a Mar-a-Lago Accord has been sidelined particularly as the dollar has devalued and so on. But it stays there. The idea of forcing interest rates to be low by force in order to it's what we call fiscal dominance in monetary policy making. And of course, we have seen examples of this in the policy choice made by Stephen Murin at the Fed, but which may increase as we have the replacement of Mr. Powell and all the others, governors and so on. That would jeopardize the credibility on the monetary policy, on the role of interest rates paid in by treasuries and so on. That would be a blow on the view of the dollar as a safe asset and so on. I would put the concerns
And so in doing so, it could then backfire, right, in terms of the interest rates
that's
and
right,
what the ultimate
exactly.
goal would be.
As all the experiences of fiscal dominance of monetary policy have shown in the region where I come from, in Latin America.
We're getting quite a few questions in the Q&A box, and so I want to get to as many of them as I can. So thank you, everyone who have been typing them in. Dr. Frankel, I had wanted to get to this with you in the first part of the conversation, but I never got there. But we are getting quite a few questions about cryptocurrencies. Kind of what is the future of Bitcoin in relation to this discussion? What role do cryptocurrencies play? And then, sort of my original one is, this is the idea of, US dollar and the stable coin. And so what's your take?
So there's certainly some that consider the cryptocurrencies a good contender for the new reserve asset that takes over to at least some extent for the dollar. I don't. I hope not. I hope not. The only way I think that would happen. I mean, the cryptocurrencies like Bitcoin and the others don't really fulfill much of a useful function. They're so volatile that they don't have a fundamental use, with the exception of evading law, evading tax law and smuggling and kidnapping and terrorism and all that. So if the cryptocurrencies become a large share of the international monetary system, I think it'll be probably bad news. It'll be associated with a breakdown of international law and order. From the viewpoint of an individual investor or from the viewpoint of a central bank, cryptocurrencies are so volatile that I think they're too risky to hold. Stablecoins fix that. Stablecoins fix the value of the currency in terms of the dollar or some other major currency. And there are some who say that if we promote dollar stablecoins, that will make the dollar more useful. There'll be an increase in worldwide demand for dollars, and that will prolong the international currency role, the reserve currency role of the dollar itself, and maybe sustain its value, keep it from depreciating further. There's probably an effect there, but I think it's pretty minor. I will say that stable coins are like money market mutual funds, except they're not completely guaranteed, not really guaranteed at all, and so in that sense are riskier than money market funds.
It's true. And if I may just add,
Yes.
I hope Professor Frankel is right when it comes to the magnitude and significance that stablecoins might acquire. Among other things, because stablecoins, if they get big enough and relevant outside the US particularly, they could erode the control by the government of over money and debt, right? And that would lead to a reshaping of the way by which our economies nowadays manage inflation, stabilize markets, and finance public spending. Besides the fact that it tends to replace the senior age. If it becomes fully fledged, senior age that instead of being appropriated by states, it is appropriated by private agents, and naturally by the way it functions, stable coins are, friendly to an opportunity for individuals, for emperors. Uh, so one should not underplay the challenge associated with the rise of stablecoins.
Yeah, kind of interesting back and forth between the geopolitical and geoeconomics there. Um, we have a question here. Why don't I start with you, Dr. Frankel, and then Dr. Canuto, you can we welcome your thoughts as well. Could you comment on the risk premia implied by current long-term interest rates, such as so the Swiss franc is 0.16%, the yuan is 1.82%, euro 3.15%, and US dollars 4.05%. Are these realistic measures of real-world risk?
If you look at the major differences of interest rates across countries, they do reflect risk. If risk includes not just risk of default or other country risks, but also includes risk of devaluation or depreciation, there is a correlation there. All the currencies, the countries just named, are pretty reliable, low default risk, and not especially high expectation of depreciation. The fact that the U.S. interest rate is higher than it was for 15 years, when interest rates were close to zero, it partly reflects the problems of the U.S., the excessive fiscal expansion and some monetization of it. I don't know if you can look at the difference in interest rates and take that precisely as an estimate of the risk premium. Possibly, but you have to decide what you think the path of the future exchange rate is going to be, unless you want to include that as a definition of the risk premium.
It's true, if I may. See, I was recently in a debate, and someone contested my argument about the exorbitant privilege by referring to the levels of interest rates in the US as compared to other countries. And then I answered by remarking that the exorbitant privilege is just one of the determinants of interest rates. The interest rates, at the end of the day, they reflect several factors. So even though the US may remain enjoying a condition of earning more on assets abroad as compared to what it pays in its liabilities, even though some convenience yield may remain between assets in the US vis-a-vis others. At the end of the day, there are other factors that also lead the interest rate, including the fiscal ones, which may be completely different, or the needs in terms of monetary policy. So those differences, they do not, and this evolution of comparative evolution of interest rates do not change any of the arguments that we've been talking about here. They have to do with the country-specific determinants of interest rates according to their macroeconomic situation and so on. What's at stake in our discussion here is mostly the survival or not of the exorbitant privilege of the seniorage in its several forms that will remain with the US to the extent that the US remains the asset, the source of the assets that serve as reserve.
I think that will be the real question to watch, is sort of where that line is when the exorbitant privilege, does that expire at any point? I'm getting a couple questions here that seem, I would say they're a good pair, and I'll start with you, Dr. Frankel. One questioner asks, how much of the current momentum behind de-dollarization is driven by global geopolitical strategy versus concerns about US fiscal policy and the perceived erosion of the Fed independence? And I'll just kind of add this one on here because I think it is somewhat similar if I can find it. And it's about whether the increased role of gold is that reflective of current uncertainty about the pace of decline in US leadership, and how you expect the role of gold to take shape.
Well, as I said, the dollar's share has been declining since the turn of the century, accelerated over the last 10 years. I think that as confidence in U.S. policymaking and U.S. macroeconomic policy in terms of budget deficits and low interest rates, and in terms of geopolitical policy, in terms of sanctions, as that concern has grown, I think that has uh, contributed to the accelerated decline of the dollar's share as a reserve currency, and the other uses of the dollar as international currency.
Yeah. About the gold, okay? We have to look at the facts. To a large extent, the rising share that we have seen of gold as part of reserves. But first, there is a strong price effect. It's not in terms of volume of transactions and so on. It is the fact that the price of gold has, for many reasons, come up to the roof, less than substitution. And second, there has been a strong purchase of gold by some central banks of emerging markets, but not many. We're talking about here mainly for obvious reasons, Russia, right? China has also bought more gold, and Turkey. But it's my point is that it's an exaggeration to compare, to think of the rise in value of gold as official reserves as any indicator of a replacement. And obviously, gold serves as a reserve of value, but not as a payment. We should keep this in sight.
Right.
Right. There's a reason why why we moved away from that to begin with. Let me see. We have another question here. And the questioner writes, if the US has violated the trust of our exorbitant privilege and the recent trends implies that investors want to protect themselves by shifting into gold and the rest of currencies, doesn't this suggest that a sort of mutual fund of currencies, say of the G20 national currencies, like what protocols on printing money must be in place to make such a plan workable? So is it possible to get kind of a basket of currencies that takes this role? And what might be needed to do that? Dr. Frankel, do you want to take this first?
Baskets of currencies generally don't work. I mean, some central banks, some countries peg their currency to a basket of currencies, and usually that doesn't work well. But issuing an international currency that is a basket of currencies especially doesn't work well. Dr. Canuto mentioned the SDR, which stands for Special Drawing Right, and you could think of it as the currency that the IMF issues. That's a little loose, but you could think of it that way. And it's defined as a basket of currencies. And he mentioned that China's campaign to get admitted to as a component, one of the currencies in the basket that determines the SDR, which they eventually succeeded in doing. But the SDR has never caught on as an international currency. I mean, initially, some countries pegged their currencies to the SDR, but it really didn't work. And as he said about the BRICS currencies, if that's going to be defined as a basket, or even if it isn't, I just think that's a non-starter. So the multipolar world that we might be moving towards is not going to be anybody gets together and issues a worldwide currency that consists of a basket of international currencies. Rather, it's going to be individual international currencies competing against each other.
Right. Particularly as payments.
Yeah.
Right. As you
Long
said,
way to go.
SDR and gold are not equal as
Yes,
payments.
yeah. But this does not, of course, deny the relevance of SDRs because it gives the countries, through their central banks, the ability to withdraw currencies that can be used to intervene in markets. And so it's an accounting money that is given to central banks, but central banks can use it. So ultimately, they are important, not as much as having their own currencies to intervene in the markets, but it's fine on a limited sense. The euro I would say, provided that, to get the house together, that's the difficulty. See, we had the Eurozone crisis. To a large extent, we had the Eurozone crisis because the monetary unification was easier than the fiscal unification. And it was exactly the doubt about the sustainability of the debt of the peripheral countries in the Eurozone crisis in the beginning of the previous decade that was only, let's say, calmed down when Mario Draghi came with his "we will do it whatever it takes," and had a second round of let's say relief as well when finally the European Union issued a bond being owned by the European Union. So the way forward, in order to reinforce, it's not easy, European Union. This part has been incomplete, the fiscal one, not to speak of the unification of banking systems and so on. So, but I would say that if they can get their act together and offer to the world accessible without capital controls and so on, access to a deep collection of investment grade assets, the euro can rise in its regard.
So I think the big takeaways, because we're at the end of time, is that the international financial system is going to be looking a lot like the international world order, which is that it's going into this multiplex domain, and we don't quite know where things will go from here. But it sounds like for now, with the lack of better alternatives, the dollar is the world's reserve currency, and we'll just kind of see a slight shifting in what's happening with the others. And I really appreciate your coming on today to help us illuminate that. So thank you. For everyone listening, just a couple of real brief housekeeping items before we leave. Our next event we have next week is it next week? Yes, it is, after Thanksgiving, with Martin Wolf on Wednesday, December 3rd. So we'll be looking at the economy in an age of uncertainty. So that is free and open to all. And for those who are in New York, we have a conversation with Ali Wine in person on December 10th. So if you're not a member, we encourage you to join. And of course, this is our season of giving. We are a nonprofit. We encourage everybody to donate. It allows us to keep these conversations free and open to people around the world. And we do have people in over 100 countries listening. So we really appreciate any support you can give. So with that, Dr. Frankel, Dr. Canuto, thank you so much for your time today. I really appreciate it. Take care, everybody. Happy Thanksgiving.